What's up, guys? Welcome back to the channel. This is Tumi Solomon Wisdom, and in today's lesson, we'll be diving into synthetic indices. I'm going to explain synthetic indices using smart money concepts, where I'm going to show you how you can make informed trading decisions by understanding the structure and the dealing range. Okay, I'm actually going to touch a little bit on the concept of dealing range, and I don't think I've talked about it on this channel. So this is actually some of the confluence I'm going to add in today's lesson. Now, we're going to specifically simplify these price actions on boom and crash. Yes, sometimes I teach about synthetic indices. I think I usually talk about it twice a year, and this is the first time I'm talking about it this year. So the chart examples is going to be on boom and crash. And I always teach with evidence and proofs, but today I got no evidence. Why? I don't usually trade synthetic indices. You all know that. Why I'm teaching this is because I have a lot of synthetic indices who trade smart money concept on this channel, and each time I post a video, they usually comment I should at least make a lesson for them. So that's why I'm covering this. Now, I'm going to share my personal backtest experience, just like I said. I don't trade it. What I'm going to share is a backtest experience, examples of price actions, and I'm going to give you tips to improve your win rate. And you have to keep in mind that I don't trade synthetic indices. My reason is that there is no fundamental backings, and another thing is the market is being controlled by algorithm. But that's just totally my personal opinion. People trade these and they make money. As a matter of fact, a lot of people and students send results, they get here, and based on back tests, you can win with smart money trading here. So everything is based on mindset and what you think works for you. I focus on currency pairs because it works for me. You see someone else trading commodities, someone else trading futures indices just because it works for them. So if you follow me, I'm not against any trading style, any trading pattern, or any trading instruments. Do what works best for you. So let's jump straight into this. So if you are new to the channel, consider subscribing to the channel. Like I said, I'm Solomon Wisdom. Here is Born to Trade. All we do is to talk about smart money trading. So the very first example is going to be on crash. And I believe you already know what boom and crash looks like. This is actually crash right here. And you see price is crashing, right? The major move is usually when price crash to the downside. And this is actually the 2 minutes time frame. Now, we usually get some retracement, and after that, you expect price to crash again, retrace, crash. So it's crashing because this is crash. But if you go to boom, it's going to be the opposite because it's going to be booming to the upside. Now, let me give you tips on what you need to see to be profitable trading with these patterns. The kind of price actions you want to see if you want to trade boom and crash. Now, firstly, you need to understand the structure, right? I'm not going to talk about institutional order flow because I don't think there is institutional footprint here, even though we still consider pricing efficiencies while trading our zones. Now, let me give you a little chart example, and it's going to be a quick one. So right here, the kind of price action you want to see is very simple. Just understand the price range, understand the range price is same, right? Understanding what price is doing once it's in a range. Now, we're going to use a bullish example, and I believe during the chart example, I will still touch on bullish and bearish examples. Now, let's take this as an example. If you're talking about the structure of the market, this simply explains that the structure is bullish. Now, if you want to understand the range you are dealing with as a trader, is actually very, very important, because if you look at this is actually the high of the range, and this is the low of this current range. So everything we have right here is minor structure, or we call it internal structure. If you have this kind of price action and price expands again from the low of the range and breaking above this high and forming another high, this is a valid break of structure. So if you see something like this, where is your new dealing range? This is your range right here, this low right here, and this particular high. This is your new range. So everything inside this particular range is what you're going to consider, and the price actions you see inside this range is going to determine how you get involved in the trade. So you see price retracing, and during this retracement, you can as well look to short the market, because you know that price is actually trading down inside this range, because this is what the low of the range, and where is the high of the range. This is the current high of the range. So taking counter trades here, it's possible, but have in mind, while you take counter trade, you should be aware, because if you try to measure this from here to here, you see we have the equilibrium level. The equilibrium level is more like the midpoint of this particular range. So be selling at the high of the range to the down part of the range. And once price gets inside the range, this is when you should start thinking of bullish trade opportunities. Why? We usually have key levels at the extreme level of this area. And another thing is we usually look to buy from the discounts, and when price is at the premium, we look to sell. So this is one thing you have to understand. Another thing is you might get a question because sometimes you might actually see price breaking underneath the daily range, right? It's possible that price is going to maybe break underneath the range and still react to the upside, breaking structure to the upside. So if you see something like this is actually going to improve the probability of your trade opportunity. Why? We actually had a spike, and this spike underneath this low has now showed that there is institutional footprint, that the institutions has stepped into this market, at least tagged out some buyers and sellers in this market, those who has their stop loss underneath the low. Price has now tagged them out of the market, and we have the reaction to the upside. So this is why we have this liquidity sweep and the impulsive move that breaks structure. Now, this impulsive move definitely has to leave inefficiency. If there is no inefficiency, there is no trade. No matter how little the inefficiency is, once there is an inefficiency, then it's valid and you can look to get involved, right? So at this particular point, seeing this, you can as well look to maybe mark your point of interest, and then if there is room to sell, you can look to sell and anticipate that price returns back to this point of interest. Note, you still need other smart money confluence. Once you mark your zone, you have your liquidity sweep, you have your pricing efficiency, break of structure, then how price returns back to your zone is actually very important. You want to see a corrective return, and if there is need to get a confirmation right here, you can as well look to do that, because sometimes when price retests the range, you might see some reaction, then price comes back for the mitigation, either the breaker block or the other block we have under here before the continuation. All this depends on you and how you wish to approach the markets. I hope this makes sense to you. So let's see some charts examples. This is crash 900. Currently we're on the 2 minutes time frame, but let's move to the 2 hours time frame. So moving to the 2 hours time frame now. So here's the 2 hours time frame, and I'm going to do some breakdown starting from this particular chart. So what I said is trying to understand what price is doing, understanding the trend of the market is very important. So I would want us to do a deeper breakdown. I'm going to do it by reading the market structure, right? Let's read the market structure. Now we're going to read from this particular point. Now from here, what can you see? We have price printing the low, pullback continues to the downside. What does this tell you? This is your lower low, this is your lower high, and price was able to print a new lower low. After that, price pulled back, continues to the downside. Here is your lower high, your lower low. Now, price reacted to the upside, shifting in structure. So this is a valid market structure shift at this particular point, okay? This is price shifting in this structure. So when you see this shift in structure, you should now anticipate that, okay, there is need for price to change in structure, and you still need some confirmations. And what is the confirmation you have right here? After we had this shift, price prints a high, and we have a pullback. You see, price prints this high, pulls back, prints this low we have here. And after the low was formed, price moves to the upside again. You see, we had some range over here, even though some people actually consider this as a shift in structure. But if you look at it, maybe from the general context of the market, this is more like price slowing down a little, and we had a pullback. So after you pull back, price formed this low we have here. And another thing you can see is that price actually swept liquidity underneath this low. See, price takes liquidity and it reacted. So if price actually came back to this area, it would have been a good area to trade from. So let's first stick to reading the structure. You see, these are change of character. Price forms a high, forms a higher low. This is a new higher high. Price forms a new higher low. We have some internal structure right here. Price moves higher to form a new higher high. Now, after price formed that higher high, we see we have another pullback over here. You see price pulls back, form this low, reacts to the upside again. So this is price pulling back, forming this low, and this is actually the price range over here. You see, this is the price range. Everything we see right here is just an internal structure. Forget we have a complex pullback around this area, but this is actually an internal structure. So after price formed this low, you see it reacts to the upside around this particular area, forming this high. And after this high was formed, we have another pullback forming this low. So this is a typical example of how to read the market structure. You see, forms this low. Now, this is the point I want us to pay attention to. Now, let me try to zoom in and explain further. Now, after this low was formed, this was a higher low. You see, price reacts to the upside with an institutional candle. Yes, a lot of people might actually decide to trade from here. If you trade the smart money concept, it's possible that you're going to mark this zone to trade from here. Is it a valid zone? Yes, but you see, price actually spiked underneath your zone, and we see something like this. If you see this, no need to panic. All you have to focus on is on your win rate, okay? Focus on your win rate and your risk reward ratio. So after this particular example, I'm going to talk about the importance of win rate and how you can use win rate and your risk reward ratio to make yourself a profitable trader. It's actually going to be at the end of this particular example. I'm going to give you that tip. So after price forms this low, sweeps the liquidity, react to the upside, forming a new higher high. You know that this was the price range, but price swept the low. Now price forms a higher high, sweeps the liquidity, react to the upside, breaks structure to the upside. Now, where is your current price range? This low right here and this particular high we have over here. So once you have this, can as well mark it as your price range. So every other thing price is doing inside this range is what we call what an internal structure. Now, what you can possibly do at this particular area is simply trying to mark your point of interest. Now, one of the things that made this a high probability setup is the liquidity sweep. So let's start from the liquidity sweep. Liquidity sweep is simply price moving underneath this low. Yeah, even if you're a smart money trader trying to trade from here, truth be told, you've been swept out of the market and you lost money right there. Okay, so you don't have to beat yourself. You lost and you have to take that. So that's it right there. Liquidity sweep right there. Price reacts to the upside, and the second confluence we have right now is what? Price breaking structure to the upside. So I'm not going to do leveling, but let's just focus. Price reacts to the upside around this particular area. So you see, this is a good sign. Liquidity sweep reacting to the upside. Now, if you zoom in a little, you're going to see that we still have some inefficiency. I said, no matter the size of the inefficiency, it's still valid. We have an inefficiency right here. We have another one right here. So once you've been able to spot these inefficiencies, you're going to look to mark your zone. And how did I say is the best way to mark your zones? One of the best way to mark your zone is simply marking the candle that swept that liquidity. So this is actually the candle, the bearish candle that swept the liquidity. You just mark it and extend. Now, another important thing is price building liquidity inducement area. And from what I can clearly see from here, we had a very large liquidity void. You see, we have this liquidity void, which price came back to fill. Okay, so a lot of liquidity was resting at this particular area. So personally, I might look to mark here as my liquidity inducement, or I mark the one we have lower. Okay, so this was the trade opportunity. Now, trying to extend this to see when price return. You see, price came back, taps into our zone. You see, with almost zero drawdown, taps into our zone, and we have the reaction to the upside. You see how price respected the zone nicely, taps into the zone, and it reacts to the upside. Now, if you're actually trading this on the lower time frame, the price action is going to be different because actually crash we are talking about. But talking about how to approach it with smart money concept, this is actually one of the best ways to approach it using all those smart money strategies. Okay, it's one of the best way you can look to approach it. So price mitigates a level and react to the upside. Now let's try to see what price was doing in the internal structure, because this is one other thing I said. Now, if you watch the lesson I dropped in the last 2 weeks or last 3 weeks, that particular example was on AUD USD. So we had this kind of price action where price actually shifted in structure, maybe around here. If you don't believe this one as you shift in structure, you can as well mark this particular one. But this is the important thing I want you to notice. You see, we have another liquidity sweep pattern over here. You see, price takes liquidity underneath this low before it taps into a point of interest. I hope you see that clean liquidity sweep, price taps into the point of interest, react to the upside, and now we have a build of liquidity. Yeah, price is actually yet to take the external range liquidity, because the truth is the external range liquidity is a profit target, and for what you can see right here, price is yet to take that external range liquidity. All we have here is equal highs. We have highs that are equal, which means that we now have liquidity resting above the high, which is going to be a target. Over here we have equal lows as well, which means that liquidity rests at this area. Now, what is the simple thing you're going to do? The simple thing you're going to do is marking your point of interest. So marking that candle that swept the liquidity. You see, we have another bearish candle right here, which swept the liquidity we had underneath this low before this institutional move that left some inefficiencies. building liquidity breaking structure as well. This is actually a change in market structure because this is an internal structure inside our dealing range. Okay, this change is actually inside our dealing range because where is our range? This is the high of the range and this is the low of the range. So we are just taking advantage of everything we're seeing here. And one other thing I said is once price is at the discount level, you can look to buy. And at this area, you can see price is at the discount level. So it's a good buy opportunity. We actually had a sell opportunity around here, but I wasn't interested in explaining that. I just want us to focus on the obvious thing. So extending this right now to see how price returns. See, price came back, mitigates the level, giving you another entry. Hope you can clearly see that, giving you another clean entry. And see, we have another institutional move right there. Now, imagine you want to get involved again. What are you going to see? At this particular point, you want to maybe get involved from a lower time frame confirmation. So if you drop to a lower time frame, you're going to clearly see this. So this is price moving underneath this low, another liquidity sweep. Pricing taking the liquidity underneath this low. So this is why I said you should pay attention to what price is doing. So any pair you want to trade, any instrument, the most important thing is understanding what is happening there. So after the liquidity sweep, price moves massively to the upside. Now here could be the change of character. If it's actually on a lower time frame, this is your most obvious change in market structure. But if you're doing it on the higher time frame, the one we have over here is the obvious change in market structure. So let's assume you're actually getting involved from the lower time frame and you're seeing this as a confirmation trade. And based on the recent lesson where I talked about updates on entries, getting involved from a breaker zone. So if you're getting involved from a breaker zone, where are you going to get involved right now? You see, this is actually your supply level which failed. And if you're trying to get involved from there, you see we had the retest of the breaker level. This turns into a breaker block, having your stop loss underneath this low. And from there, you see how far price has moved away. And you see in the space of how many weeks, this from the 13th of April, and the current price action is today being on the 16th day of May. You see, we've had series of wins using smart money concepts. So I believe this has actually helped you understand how profitable this strategy is. Now, let's talk about the win rates because I said something about win rates and how important risk to reward ratio is. Now, one thing I noticed while doing my recent backtest on boom and crash, because I've been doing some backtests on VIX, jump and all that, step index and all that. But talking about boom and crash, I've not actually taken my time to do a deep backtest. Now, based on my deep backtest on boom and crash, what I've noticed is this particular pattern has low win rates. Yeah, the win rate is about, I think, about 30%. But the question is, how can I be profitable if you want to trade this strategy here? Now, let's do it quickly. This was the first place we got involved, right? We got involved right here. So let's try to see the risk to reward ratio we actually got if we take this trade. So this particular one, what was the risk to reward ratio? This was about 5.5%. So this is about 5.5% win rate based on this trade. Now, seeing the second, okay, this particular one, so this particular high is about 4.26, right? About 4.26. 4.26. Maybe let's say you try to get involved from a confirmation zone. If you're getting involved from the confirmation zone, that is the breaker zone, and then your stop loss is underneath this low, where is going to be your profit targets. Your profit target is going to be maybe around this area, and this one offered about 5.5. You see, we have 5.5 here. Over here, we have 5.5 again. Over here, if we try to adjust, we have 4.26. Yeah, we have 4. So 5%. 4%, 5%. Now, it has low win rates here. Now, you can actually improve this with your risk to reward ratio. So you know that when you win a trade, you'll be winning good money, and when you lose, you know that you're losing 1%. So maybe you go with at least 1:3 risk to reward. Okay, if you have 1:3 or 1:4 risk to reward ratio on this particular instrument, is going to help you. Now, with this example so far, I believe you now understand that when you pay attention to your win rate is actually very crucial, because a strategy with about 60% win rate can be profitable with 1:1 risk to reward. But based on these instruments, the win rate is less than or almost 30%. So you need a higher risk to reward ratio like 1:3 or 1:4, just like I said. The key thing in trading is actually finding a strategy that fits you and knowing the instruments that fits you the most. So adjusting your risk to reward ratio to match your win rate can actually make you profitable and you achieve success and perfection. Let me call it perfection based on how you trade. So win rate matters. All you have to do is just adjust your risk to reward ratio accordingly. Since 60% win rate can make you profitable if you use 1:1. Now, with 30% win rate, all you need is just 1:3 risk to reward to find it and tweak your strategy to be profitable. So I hope this makes sense to you. Let's see another example on Boom. We've seen one on Crash. Let's see one on Boom now. So this is going to be a quick example on Boom. This is Boom 300 2 hours time frame. Now zooming out, important thing is knowing where price is moving to understanding the structure of the market. So a quick sketch of the market structure. Now price is trending up. See, uptrend, uptrend. We had a shift. Price starts to drop, and over here we have a shift, which is the realignment of price. So if you're actually looking at ranges, dealing range of price, you would have seen areas to get involved. Just like here, we had a range, price retests the range, reacts to the upside. Over here, we had a shift. After the shift, we had a mitigation right here. Price continues to drop. So you see, this strategy works here, but I just want to focus on the recent price action. Just the way I do. I love recent price action. So around this particular area, price shifted in structure starts to move to the upside. So let's look at the recent break. Now, if you look at this particular area, you see we had the mitigation of this area after price moved impulsively to the upside, we traced back, swept some of the liquidity inducement we have over here. So everything I've been teaching you is right here. Although the way I trade, I'm not going to mark this point of interest, should be told. But after that, we had the mitigation if you actually want to get involved from a breaker level. So this is a breaker level right here after price sweeps the low, because exactly what I've been teaching, if you see that liquidity sweep, because this is a valid liquidity sweep. After the liquidity sweep, price moves up, come back for the retest right here, boom, continuation to the upside. See, price reacts and see price came back to mitigate another block around this area. See the mitigation, but based on how I trade, I'm not going to mark that one. I will focus on the one we have right here. Then this other block serving as my inducement area. But this is the most recent level I want you to pay attention to, identifying your structural levels. Price breaking structure, which confirms when you're in an uptrend. Another break of structure right here. Now, after price broke that structure to the upside, where is your dealing range? You see, this high right here and this low is your price range. So if you mark it, everything inside here is your range. And just like I said, you can look to maybe get involved from the high. If you want to sell to the downside, you can do that. Once price comes to this low, you can look to buy. Now, let me do a detailed explanation. Maybe go to a different time frame so you see what I'm explaining. So this is the high of the range and this is the low of the range. So maybe let's jump to the 30 minutes time frame. So here being your 30 minutes time frame, and like I said, high of the range, low of the range. Now, if you try to mark from the low of the range to the high of the range, what can you see? At this level, which is your premium level, you can look to sell from there. And when price gets to the discount level, you can look to buy. Now, you already know that around this area is your equilibrium level. So you are safe if you want to sell from here. Now, take a look at what price did. You see, after the break of structure, we have the liquidity sweep of this particular high. And what else can you see? Price shifting in structure. If you don't believe here or see this as a change of structure, we have another one down here. So price shifted an internal structure because price was now pulling back inside your price range. See that? Price pulling back inside your price range. Now we had the pullback. What was the pulling back going to do? Price pulled back to rebalance the inefficiency we have right here and to mitigate the zone we have over here. I hope you see that. Price mitigates the zone, starts to drop. We have another break if you want to consider that. You see price closed under the low, another break, and this particular level price came back for mitigation, but I'm not going to consider this as a good level. But if you want to sell, can sell from there till price drops into your zone. Now that price drops into your zone, what are you going to do? Simply select your demand level. And why are you selecting your demand level this way? This demand level is valid because it aligns with the structure of the market. Price was bullish. You see the range right here, your price range, high of the range, low of the range. And we have an expectation. Once price pulls back inside the range, possibly reaching the extreme level, price usually reacts away from there. So extending, you see price mitigate, boom, reaction to the upside. Now I've told you what to do based on your win rates. If you have low win rates in any strategy at all, or you're trading this and you're seeing low win rate, all you have to do is to improve your risk to reward ratio. Okay, good risk to reward ratio is actually going to make you profitable. So that's it. And I hope this particular one was helpful. And for my synthetic traders, I believe I've settled you all now. So thanks very much for suggesting that. And thanks for watching this particular one. I hope you got value from this. If you have any lesson you want us to cover, you can drop the topic down below. So thanks very much. See you in the next lesson.